The recovery in Australian companies and households is almost taken as a given. And this week, ANZ Bank's 65% profit jump to $6.2 billion with a commensurate jump in dividend is a sign potentially of more to come. The ANZ's annual profit now is just 4% below where it was before the pandemic. Conditions are so strong that provisions made for bad debts caused by pandemic-induced job losses and business closures have been reversed. But looking ahead, all banks have issues as inflation rises and as money market interest rates increase. And ANZ has an added problem because its home loan division lost business despite boom property conditions over the past 12 months. Joining me now, Chief Executive of the ANZ Bank, Shayne Elliott. Shayne, many thanks for your time as always. Can I just start with your home lending division? Losing market share when conditions are booming, can I take that as a sign of failure on the bank's behalf?
Well, it's not good, is it? But the reality is we are actually processing more home loans than we've ever done. So we've actually got our capacity up. It just wasn't enough for the pretty extraordinary volume that we've seen right across the marketplace. So we've got that back on track, though, Ross. You know, we dropped a bit of market share, but we've put our resources to work. We're putting into new automated systems and more people. And we're pretty confident we'll get back into growth in the first half and back to sort of system growth of our major peers at some point in the second half.
OK, but a lot of the work that you did was in refinancing existing lenders. And so that being the case, those people who were refinancing would have been refinancing at lower rates than what they had before. Does that mean really, in some ways, you've actually been refinancing but taking less money long term from those customers?
Yes, that is one way to look at it. And actually, you know, I think there's clearly a volume and the processing issue that we've talked about. But the contra side to that is our home loan business revenues actually grew more than 10% in the year. And part of that is because, and again, I'm not saying that we planned to have less volume, but part of the offset of that is, of course, our margin performance was better. So we weren't sort of heavily discounting at the front. We didn't have that sort of margin impact, and we actually held up pretty well. And so, again, not saying it was planned that way, but there is a countervailing positive that comes with that story.
OK, but does it also suggest, or it does to me at least anyway, that some of your competitors were more aggressive in picking up new business than what the ANZ was? Is it a sense maybe that some of your people were a bit cautious about who they were lending the money to?
There's no doubt there's a little bit of caution there. And, you know, at ANZ, there's no doubt we've been a little bit conservative and we can judge, you know, and again, I'm not going to make excuses here and suggest that that was deliberate. But the reality is post-Royal Commission, thinking about responsible lending, looking into a market where house prices have been, you know, rising at extremely high levels. Yes, we've been a bit more cautious, being very thoughtful and checking, you know, documents, making sure we understand people's incomes, making sure we understand, you know, everything about a customer before lending. That cost us volume. And again, I'm not saying that it was deliberate, but yes, I think it is a time to be a little bit prudent and a little bit cautious about lending. I mean, look at Sydney, house prices up 30%. In a year. You know, that says to me it's a time for prudent and sort of reasonable risk assessment at a time of such extraordinary price changes.
You're quite right, because, you know, if jobs are lost or if income somehow blips in the future, there is a worry. And then you start to see inflation, this underlying inflation that is the measure of the Reserve Bank rising significantly over that past quarter. Now, you know, this is where money market rates are rising. Banks have increased fixed rate loans as well. I mean, you know, there is a bit of a telltale sign out there right now for those people being overly aggressive in borrowing and buying property.
There is no doubt there is inflation happening in the system. It's just asset price inflation. And, you know, again, you know, as I've been saying, my daughter is doing economics at high school. You know, what's the definition of inflation? When we went to school, too much money chasing too few goods. Well, that is happening. It's just that at the moment it's happening in the assets and housing area, and it hasn't really flowed through into sort of consumer prices, the things we fill our shopping baskets with. So I think the big debate globally, not just here in Australia, is, you know, is that going to come? Is that liquidity, that excess liquidity sitting in the system, going to translate into permanently higher levels of, you know, consumer price inflation? And we saw a reasonably big rise in inflation, certainly in New Zealand, and we saw a little bit here in Australia. And so, you know, the jury's out. Is that permanent, or is it a transitory thing due to some sort of supply chain issues and other things that are stressing the economy at the moment?
Okay, so though it might not have been planned to have fewer home loans as compared with your competitors during this period, what you're saying is it might actually play out if indeed all of this stress testing you've had to do of the customers ultimately comes to fruition, that it's a real live scenario where interest rates have to be raised in the face of higher inflation.
Yeah, again, I'm not going to spin this and say it's a good thing, but to your point, there are some positives. So we wished we'd been in the game. We are back in the game in terms of volume. But as I said, more broadly, just putting aside our processing issues, it is a time for caution. You know, the reality is that household debt is increasing at much faster than household income. And at a time where there's still a lot of uncertainty in the world, I mean, COVID's not over. We're feeling a lot more optimistic. Yes, we're coming out of lockdowns, but the world's really uncertain. And what we're seeing around the rest of the world is we still probably have a bumpy road ahead.
Banks obviously have come under enormous pressure from shareholders and other groups to stop financing fossil fuel activities. You have done so in regards to thermal coal that generates electricity. Given the fact that thermal coal prices are right now at all-time record highs, has the bank actually gone a bit early with that?
No, not at all. You know, we're here for the long term. Let's not, you know, I think there's way too much conversation with the banks about the things we should stop doing and not enough about the things we should be doing. The reality is the world is going to spend trillions of dollars in the transition towards a low-carbon future. That is a massive opportunity for banks like ANZ.
You and I have done these interviews over a very long period of time. We do them every 6 months when your results come out. In 12 months' time, are you going to be around to do this interview with me? Will you still be the Chief Executive at ANZ?
Ross, I look forward to our 6-monthly catch-ups every year, and I'm determined to have a few more.
Good on you. Shayne Elliott, many thanks for your time.
Thanks.